Hey, Archie, what is all this talk about the big tax law sunsetting?
Well, Rob, let's talk about it. Just make sure you don't fall asleep at the switch if the sun goes down. I'm Archie Hoxton.
And I'm Rob Hoxton.
And this is Last Paycheck, weekly wisdom to help you retire and stay that way. Welcome back to the Last Paycheck Podcast, brought to you by Hoxton Planning and Management. We're your hosts, CFP Professionals, Archie Hoxton and Rob Hoxton. And today, we're going to talk about some potential tax changes coming up in the next couple years.
So big ones too, potentially.
Yeah, potentially very big ones. And so for those of you who remember this, in 2017, feels like ancient history now. In 2017, there was a huge change to the tax code. The largest since the Reagan era tax changes. And so now those changes were made temporary, right? So through the negotiation, it was, okay, this is gonna be in place for a period of time. And then you have the option.
A maximum of 10 years. Yeah.
Right.
Yeah.
And it has the option to renew or expire. And so right now, that is set to expire at the end of next year, 2025.
Yeah, so that's a long time from now. It seems like, and viewers and listeners may wonder, why are we bothering to bring this up now? And it's not a very long time in terms of the way that legislation works, in terms of the way that you're able to make substantial changes in your financial situation. You need a lot of lead time.
Exactly, you do. And the way the tax system works, right? Every year you get a clean slate. So you have 1 year to make decisions that have impact for potentially many years. And each year you get one shot to make the right choice. You have until December 31st, not for all decisions, but for many. And so, we've got a chance this year and potentially one more chance next year to take advantage of the way the system is currently set up before it reverts back to the old way.
And it's a huge structural change in the way that income is calculated and taxes are calculated. It will impact pretty much every taxpayer.
Absolutely.
So anyone watching or listening to this episode will be impacted one way or the other. Now, the decision that you have to make is, do you want to plan and be able to do something about it, or just kind of go with the flow and let whatever comes may come? So
yeah. And I would say that the changes are not straightforward. It is complicated. It's not as simple as saying, if it expires, you'll pay more taxes. If it's renewed, you'll pay less taxes. It's just not that simple.
So for some people, actually, interestingly, if it expires, they may actually pay a little less in taxes.
Right.
It's not a big number, but some.
Yeah. And it has to do with the reality that the tax system isn't just, okay, what's your income? Then your marginal tax bracket, and then bam. Because there's so many moving parts, different deductions, all kinds, personal exemptions, if you have dependents, there's so many factors that determine how much you pay in taxes that it's just not that simple.
So, Archie, let's start with the tax brackets. That seems like the most obvious thing that's going to happen. One of the things that happened when the Tax Cuts and Jobs Act was passed in 2017, which incidentally was passed on December 22nd of 2017. So these things never get passed with enough time to do anything about it, right?
Right, yeah.
It's always at the last minute. But when this passed, the marginal tax brackets changed. Right? So the rate at which you pay taxes at each income bracket actually went down.
Yeah.
Right. And so if this expires, they're going to go up. So maybe talk a little bit about that.
Yeah. So there's two really important things to think about with this. There's the rate of the bracket, but then there's also the income level. We call it income breakpoints for the bracket. So, let's say right now, the first bracket is 10%. If you make anywhere from $0 to $23,200, those dollars are taxed at 10%. right? The next one up is 12%. And so the dollars that you earn that fall between $23,201 and $94,300 are taxed at 12%, so on and so forth, just to get kind of a reminder of, the tax bracket. So there's the percentage, and then there's the income level. Both changed, and both are likely to change again if it reverts back. And so I think that's the first thing to recognize. So the rates will go up. However, what's interesting about it is that the income breakpoints are going to change.
They're going to go down.
Right, they're going to go down.
So you can, the rate at which you bump into the next highest marginal tax bracket there's a lower threshold.
Right.
Which means you're likely to be subject to the higher rate at an earlier point than you would have been, certainly now, and potentially even back in 2017.
So, exactly. So as an example, this tends to happen more dramatically in the higher tax brackets. So let's say right now you earn $300,000. Right now you'd be in the 24% tax bracket. If it reverts, you're going to go into the next tax bracket up, the 33%, which is higher. So you'd be in a higher tax bracket and a higher rate than the next higher tax bracket now, which is 32. So you're going to be at 30. So
double whammy. Now there are some brackets that don't actually change.
Right.
It's what was it, the
10%
and the
12%.
12%. No, 35%. Well, anyway, the important thing is that this table is included in the notes for this episode.
Yes.
So you can check it out.
It does get a little complicated. So it is.
So the 35 doesn't change. So 35 stays 35, but right above it, 37 goes to 39.6. Okay, so 10 is still 10. The 35% marginal bracket is still at 35, but the point at which you hit that comes more quickly.
Yeah, lower income, less income is taxed at 35%. We won't go through all the rates in detail. We have that in the show
notes. Check out the table. But the way that your taxable income is calculated is going to change a lot too, right? So right now, not that many people, in a grand scheme of things, not that many people are actually taking or itemizing their deductions. Many people are taking a standard deduction, which is going to change substantially.
Yeah.
Right?
Because that was one of the major changes in 2017, was a radical increase, essentially a doubling of the standard deduction, which meant that unless you had itemized deductions, so if you put together your mortgage interest with the capped state and local tax of $10,000, and you put that together with charitable giving and potentially certain medical expenses subject to limits, you put all that together, and if it exceeded the standard deduction, which was double what it was previously, only then would you take the itemized deductions. So if that goes back,
a lot more people are going to have to keep track of all that information, and it's going to be a much bigger deal.
Got to get a refresher on what is actually deductible. Keep track of receipts, make sure that you look for all the opportunities in your life where you could take deductions.
A positive change would be that we would likely see SALT deductions go from a $10,000 max to a 100% deduction, SALT being state and local taxes. For people that live in states like in the Northeast where property taxes and local taxes are a huge chunk, they're going to be really happy to know that happens, right?
Yeah, because if your state and local taxes are $15,000, that's $5,000 worth of deductions, which is, that's a serious, reduction in your income. If that's going untapped and unused, that's you may unlock that tax savings again. If this
another positive is that miscellaneous deductions above 2% of adjusted gross income, including unreimbursed employee expenses, those are going to be deductible again, most likely.
Yeah, that includes investment advisor fees, which
we like.
Yeah, which is one that many people really lamented the loss of, and because it allowed for having someone help manage your investments, allowing them to deduct those expenses. I mean, that was an awesome incentive to
Same with your
work with someone who
your accountant
can help you.
as well.
Yeah.
Your CPA fees, all of that. Those ought to be deductible, and they would be again, most likely.
Mm-hmm.
And then why don't you touch on the personal exemption, because that'll come back.
Right. So, yeah, I mean, and this was one that, again, they lost personal exemptions, and the justification was, well, we're increasing the standard deduction so high that, it's going to be okay. It's not going to be a huge loss for most people. You can make the argument either way, but if we adjust for inflation, a personal exemption would probably now be about $5,050, right? And that's if you're claiming a dependent on your taxes, and you can reduce your income by the amount of it'd be $5,050 potentially.
If you read between the lines here as well, because it covers your dependent children, right? So if you if you decide to have give me lots of grandchildren, you're going to actually maybe maybe pay less in taxes by having all those children. Just an idea.
Well, and it's nice. It's a nice incentive to, have children and then take some of the burden off of people who have children. It rewards them with a little bit of a break in their taxes since they've got, the expenses of raising children. So,
Archie, one of the parts of our population that really kind of, I think, probably suffered because of this doubling of the standard deduction back in 2017 and the fact that many fewer people were actually itemizing, is that charities really took it on the chin, I think, because suddenly that charitable deduction probably went away for most people, unless they were itemizing or unless they were doing qualified charitable distributions from their IRA.
Yeah, but right? That's only 70 and a half and older.
That's right. So,
it's a small
which is many of our clients, right? So that might be a possible win for charities, which is wonderful. We did a show on the impact for charities not long ago. And there are a ton of changes coming for small businesses, which we could talk about, but we don't really have the time and the length of this episode to touch on that. But
yeah, I mean, just a quick, the big one is probably the qualified business income deduction going away. That was something that was brought in with the Tax Cuts and Jobs Act in 2017. That going away could be pretty impactful for small business owners who save money using that deduction. And many other changes. So
another huge one, which will apply to, a much smaller subset of our population, is what happens from an estate planning standpoint. You want to touch on that?
Yep. So right now, individuals can pass in their lifetime $13.61 million tax-free, transfer tax-free, estate tax-free.
A married couple is double that, $27.22 million. Yeah,
exactly. So
that's a big number. That covers a lot of taxable estates that are from small business owners, farmers, and such.
Right. That will come down to $7 million for individuals or $14 for married couples. So you get more people that are going to be paying estate taxes and more in estate taxes. So and that's relevant for a very small segment of the population, but segment is going to grow potentially.
It does highlight the reason why planning has to start now. If you want to take advantage of some of the strategies that can help from an estate planning standpoint, you got to do it now, because if you wait until late next year, there are not that many estate planning attorneys that are going to be able to do this work. And so you got to get on their dance card now.
Yeah.
The other thing is, and another reason that we want to bring this up with viewers and listeners right now, is because there are some things that you can do before the potential sunset to manipulate the recognition and the timing of when you recognize income and deductions. which if you wait to the last minute, and you could picture this, there will be this haggling on Capitol Hill over this sunsetting of this tax act, regardless of who's in control of Washington. And it could be in the final hours of the year next year.
Right.
And leave you no time to do anything. So if you want to do things like do Roth conversions at a time when you believe tax rates are going to be lower for you, you got to be on the ball. You got to be thinking about that now.
Right.
If you have the ability to control when you recognize expenses or recognize income around the calendar year, the top of the calendar, you got to be ready to do that, and you got to be thinking about that now. So timing is so important.
Absolutely. Yeah. Or even just switching from pre-tax to Roth for your regular contributions, whether it's, and those dollars, are going to be, if the change happens, they may be taxed at a lower rate. You're preserving, you're taking this opportunity to shelter those dollars from a higher tax rate in the future. Again, with all of this, it's important to work with a planner, financial planner, CPA, because we don't know. And so if you're going to recognize income now in anticipation of potential higher tax rate in the future, there's risk, right? You're kind of doing, it's a bit of a gamble. So we don't know what's going to happen.
But it does make sense to plan, have a strategy, be able to execute on it, and not limit your options.
Absolutely.
Yeah.
I think that's really important. So I think that about covers it. I mean, that we could go on, and this topic is so massive. We could do 20 episodes on this. But we hope that this at least gives you an idea of what may change if the law sunsets, and what you should be doing to prepare. So if you like this, please leave us a comment, ask questions, reach out to us, text or call, shoot us an email. Share with your family and friends, like, subscribe, hit the bell for notifications, and I will look forward to seeing you next time. You've been watching Last Paycheck, weekly wisdom to help you retire and stay that way. If you like this show, be sure to hit like and subscribe. Last Paycheck is available anywhere you get your podcasts.